Well, good morning, good afternoon, good evening, friends and family. My name is Amos. Welcome to another episode of the Compounder's Corner. In this podcast, we'll be going over the companies reporting their earnings this week, and we'll just be talking about the stock market in general. If you can't tell by my voice, it's a little over 6 a.m. here in Japan. And before we hop into the podcast, I wanted to let you all know that we have a promo code for a free month of Stock Analysis Pro, the website that I'm always using on this channel. And if you're interested, the link will be in the pinned comment. And in case you missed it, some videos that were recently uploaded onto the channel, look, I'm starting to get my upload cadence back on track. Prior to having baby girl, who just turned 7 months old today, I used to upload 1 to maybe 3 videos a day every single day. After she was born and I became a stay-at-home dad, taking care of her full time, dude, it's been a struggle. But I'm starting to figure out it doesn't matter if I'm tired, sleep deprived, stressed out, or have vomit or doo-doo on my shirt. I gotta film because the channel is tanking, right? And this week we were productive, but just in time for the big move back to the US to shake it all up again. Because I know once we start moving, it's going to be such a long process. Because to go from Japan, where I've been for the past 4.5, 5 years, back to the US, it's going to be a lot going on, right? So I already know I'm not going to be able to upload for a long time when that happens, but that's neither here nor there. So recently I uploaded a video in response to the dividend irrelevance theory with reputable sources. I treated that video very academic. There are citations to prove, even though the claims are factual, they're not practical, and there's a huge difference. And then I also uploaded episode 7 of the Cheese Public Portfolio series, where you get to see all of my holdings and my thought process behind them. And it showcases my newest big position. I went pretty big into a particular ticker. And in that video, we also addressed the question as to how many stocks should be in a portfolio. Obviously, it's very subjective, but I give my take. And then yesterday, I uploaded a stock analysis and a deep dive into Medtronic, the medical device king. And it's probably one of my better works in terms of dissecting and analyzing a company. So you should go and give that video a watch. And on a high level, here are the biggest takeaways from this week's earnings. Number 1, the AI bubble goes on with NVDA reporting after the markets close on Wednesday. We have Vertiv, the HVAC play on data centers, and analog devices before the markets open on Wednesday. And I say AI bubble because we are in an AI boom economy, a K-shaped economy where the top 15%, the Pareto's principle, they're responsible for 80% of the economic spending and keeping the lights on for a lot of the places. So HVAC, construction, utilities, and anybody else supporting the hyperscalers to build out their data centers, dude, they're thriving right now. And that's primarily why the NASDAQ 100 and the S&P 500, why they're at all-time highs. Although, if you take a look at the other sectors that are not involved in the AI bubble, dude, they're struggling really hard because of inflation, because of tariffs, because of the consumers changing their behavior in terms of their spending habits. It's a very interesting timeline to live in. And then we also have software stocks such as Zoom reporting after the markets close on Thursday, also Workday, and we have Intuit reporting. And in the past few weeks, the software stocks like Atlassian, Monday.com, and some other ones, they've been reporting and they've crushed it. And so if you take a look at their stock price appreciation, I guess only for the past 5, 10, 15 days, it's like 20, 30, 50, 60%. It's kind of crazy to see, just like what we're seeing with the health insurance stocks. 50, 60, 80% returns in the past 20, 30 days. And then we also have retail chains such as Target, TJ Maxx, Ross, Urban Outfitters, Lowe's, Home Depot, and then BJ's. Honestly, between you and me, Costco is the best in terms of the warehouse retailers. Sam's Club, I would say, is up there as well. But BJ's, dude, I used to have a BJ's membership and I canceled it so fast. It's subpar in comparison to the peers. But anyways, there's so much more we have to talk about in this episode. So now we're going to take a closer look at each day of the week and do a deeper dive into the companies that are not visually represented on the screen. And I'll be cognizant to do a better job of showing you what's on the screen as I talk about it, because I do have this weird tendency to close my eyes and just talk, and I just ramble on. But I also understand not everybody listens to these podcasts as just an auditory thing, right? Some of us also like to have a visual thing up here. So I'll try to do my best to keep whatever's on the screen interactive. You have my word. I'll give effort, okay? All right, friends and family, the green tea is starting to kick in. I'm starting to feel a little more alert and awake. Kicking things off on Monday, we've got Baidu. And the best way that I can describe it from someone who does not live in China, it's the Chinese Google, the equivalent of the Mag 7 over there in China. It's the search and online advertising king in China. And speaking of China, I don't know if you missed it, but Trump had a meeting with the Chinese leaders this past week, and he brought the biggest names and CEOs with them, including Elon Musk, the big bank CEOs, the CEO of Cisco, and some others, right? And the thing is, nothing crazy came out of it, right? I think there was a lot of hype, a lot of hope, a lot of optimism of like, oh my gosh, these two countries have been butting heads for the past 2 years with the trade wars, retaliatory tariffs, and everything else. But hopefully we can kiss and make up. And that just didn't happen. Retaliatory. I just realized I butchered that. But anyways, leading up to that meeting and during the days of the meeting, the markets rallied. So I think they were pricing in a new trade deal where tariffs were going to be melted off and some favorable outcomes would happen for us. But no, nothing. So I don't want to be a doomsday, negative Nancy, a grouchy Gary, but I definitely do think we're going to see a bit of red on Monday and Tuesday to reflect nothing concrete happening from the meeting to benefit the Americans. Because think about it, right? Everything went up like 5, 6, 10% Wednesday, Thursday, and whatnot. But if nothing's going to come of it, of course the markets are going to pull back, right? It's almost common sense. I'm not even trying to sit here and pretend like I have a genie in a bottle telling me and whispering things in my ear like, hey, you should shave your mustache, or hey, the market's going to... No, it's common sense. On the flip side, though, if you think about it, nothing terrible happens. I'm so sorry. I forgot that I need to interact with the screen. So let me just, I don't even know. Maybe we can click on Baidu and take a look at it while I talk about it, right? The Chinese, they said that they might buy 200 commercial planes from Boeing, because yes, the Boeing CEO went there. And the Chinese did say that they were going to, or try to buy more U.S. soybeans and beef, because look, I'm not from rural America, okay? I'm not from the Midwest, but based on my understanding of economics, the farmers in the U.S. have been suffering big time ever since the tariffs and the trade wars happened. I feel like they were the biggest, the ones that had the biggest hit. Because once the Chinese stopped buying their stuff, dude, they've been suffering. But I think, thinking about the meeting, my gosh, if you invested into Baidu back in 2021, you'd still be in the red 27%. The biggest loser from the meeting was Jensen Huang's NVDA, because he also went there, right? Because China said, no thanks. They don't want to use the latest and greatest chips from NVIDIA, because for the longest time, the US government was like, hey, you're not allowed, when I say you, I'm talking about NVIDIA, you're not allowed to give China the greatest chips because we don't want them to catch up to us. And so the Chinese, instead of just sitting there and taking the beating, they were like, okay, fine. We'll do it on our own. So they're trying to rely on their own Chinese chips for their data centers. From my understanding, the company that's going to be doing that is Huawei. I guess they're not publicly traded, but yeah. And the Chinese are trying to reduce their dependence on the American chip makers. Now, from a business standpoint, it makes all the sense in the world. See, if you put all of your eggs in the basket of America and relying on us, especially the NVIDIA chips that may or may not have tariffs imposed upon them and restrictions, and then the chips are used as a bargaining tactic, of course that's going to piss you off and you're going to develop your own. Over the long run, I think that's the right play because that's what Apple did as well, right? They severed their ties with a lot of the chip makers like Qualcomm, Skyworks Solutions to make their own chips in-house. And the iPhones are probably one of the best examples of how it keeps your margins in a better position. But also the MacBooks, ever since Apple severed their ties with Intel, dude, the MacBooks and the M series chips are pound for pound the best. So I think Google is also doing it with the Tensor chips. And yeah, that's why I personally prefer the picks and shovels to the data center movement. So I know a lot of people like to focus on NVIDIA, Broadcom, or Marvell, but think about it. The physical support, the infrastructure, the ones selling the equipment, the HVAC, the utility power, they don't care who's the winner or whose chips are hot or who's in first place now because they still get paid the same as long as the data centers are sprouting up. Having said that, I remember prior to Charlie Munger's passing, he was pretty bullish on China and Alibaba. And I remember at the time, it weighed pretty heavily on my mind. Like, should I follow Charlie into this or not? And ultimately, I think China, they have a population that's about 3.5 times the US. And and the growth catalyst there is their, I guess, demographic. It's changing from being farmers and being in poverty to now largely middle-class citizens, right? Where they have a lot of disposable income. So here in Japan, especially in Southeast Asia, you'll see boatloads of Chinese tourists because now they have a lot of income to just spend it and do what they want. And that's why Starbucks, McDonald's, so sorry about that, my throat. KFC, Apple, Lululemon, Nike, they all reference China as the tailwind, right? But here's my thing. When it comes to investing directly into Chinese-based companies, especially with the CCP and the geopolitical tensions and everything else, I never got around to putting a single dollar into putting towards Alibaba, Tencent, Xiaomi, Neo. Do you know what I'm saying? I feel like that's a real threat. Because even if the companies are executing pretty stellar numbers, I mean, Alibaba is not a really good example because fiscal year 2026, top line only grew by 2.7%. And that's because the Chinese economy right now, it's struggling. We talk about that in the Medtronic analysis. So the tariff war is definitely hurting the Americans, but it's also hurting China, and it's also hurting a lot of economies around the world. I think the sooner we just kiss and make up and end all this stupid nonsense about, oh, you do 50%, then I do 70% tariffs. It's like, once we cut that out and understand that we rely on each other economically, I think the better businesses will be. Obviously, that's a hot take, probably unpopular, but if you've noticed, you go to a retail store, Amazon, or whatever it is that you shop, I mean, haven't you noticed the prices of everything going up as well? Obviously, that's a direct consequence of the Iran conflict, but also tariffs are being baked in so that the companies can recoup some of their losses. Speaking of which, yes, I have ADHD. Not too long ago, the U.S. Supreme Court, or I guess the court system, decided that the tariffs that we imposed were illegal and that we needed to stop it ASAP and to issue refunds. And the crazy thing is, we as the consumers paid for the tariffs, right? I think on average, the US household paid like $5,000, something like that. I can't remember off the top of my head. I read it on a Wall Street Journal article. And the thing is, we're not going to get a single penny of that. Because I remember there was a time when the current administration was like, hey, the tariffs that you're paying, we're going to issue you a stimulus check as a thank you and to show you that tariffs are working. I think it was going to be like, what, $2,000, $3,000, something like the pandemic stimulus. We're not getting anything. Instead, the corporations that file a refund, they're going to be the ones that are getting it back. So I do think the companies that do go through with that process, because obviously the current administration was like, hey, if you do it, there's going to be serious repercussions. I think the ones who don't care and go through with it, they're going to see a pretty significant boost in their net income for that corresponding quarter, which I think is going to be Q2 or Q3 of this year. But anyways, with Alibaba, it's a good company, but I just can't invest into it because of the geopolitical tension and knowing full well there's an American equivalent. So Alibaba, in my mind, is the Chinese version of Amazon. So if there's an American equivalent, I'd rather just invest into Amazon, right? That's kind of like how my brain works. But if you're invested into Alibaba and some of these Chinese stocks, I mean, I can't blame you, right? Fundamentally, on an evaluation basis, they are undervalued. It's just, I don't know. I think the whole geopolitical thing, it gets to me. And just can't do it. And then we also have Ryanair Holdings. From my understanding, it's the Spirit Airlines of Europe. Funny story is I used to be stationed in Germany when I was a young Army officer. I never actually took flight using one of the budget airlines. I just used the train to get around Europe to do sightseeing and everything else. Speaking of which, dude, I loved my time in Germany. And that's why in a future upload, I'm going to be talking about where I am contemplating on settling down in retirement when I live off of dividends. I think for most people, their answers gravitate towards Southeast Asia, like Thailand, Philippines, and whatnot, because it's pretty cheap, right? Your dollar goes a long way, and I don't blame you. That's smart. Strategically, that's really smart, because you only need like 40 grand in dividends a year to live like a king. Other people, they look to Latin America, places like Colombia or Mexico. It's also coherent, makes sense. But for me, dude, I loved living in Europe. I thought it was clean. I thought the infrastructure was solid. The healthcare system was phenomenal. So I've been eyeballing Portugal. So I'll be talking more about my game plan about that in a future upload, because this is about this week's earnings. Obviously, I would like to stay in the U.S. in retirement, but the fact of the matter is the cost of living in the U.S., it's only getting higher and higher, and the healthcare system is fragmented to the point where when I think about my older years, I mean, that's a reality, right? Because think about it. If I'm generating 50 grand in passive income from dividends and I use that to pay for the bills, to pay for the groceries, and to maintain a lifestyle where when I'm 70, I can at least afford to buy a new pair of underwear. That way I don't wear the same brown streaked one for weeks. Imagine like if I have a medical issue. Like I'm a pretty healthy guy, which I feel really blessed and grateful for. But if I do have a medical issue and that puts me into medical debt, my entire retirement game plan gets wiped out, right? So that is something to take into account. And then also on Monday, there's Trip.com. Anybody else? No, let's jump on over to Tuesday. On Tuesday, I think the biggest name right here is going to be Home Depot, ticker symbol HD. Fun fact, when I first started getting into investing, I know, I'm so stupid. I think my gateway drug was, no, that's not the right word to say. I think my introduction to the markets was day trading. And then after I made some fat profits and some fat losses, I realized that's not investing, that's gambling, right? Especially using derivatives and options. I've been on that high before and I just don't want to go down that path again. And then I started getting into index investing once I realized like, man, I don't want to gamble anymore. And then I realized, why invest into an index such as the S&P 500 or the total market VTI when I could just pick the winners and delete the losers within the index, right? And so I created my own index, a basket of stocks. So like, for instance, the S&P 500 is 500 positions, right? Instead of having all 500, I would handpick the best one or two from each sector represented in the S&P 500. All that to say, a long-winded way of saying, Home Depot, I used to be invested into them, but now I'm not. Kind of funny, right? And I do think that mentality, that mindset, I no longer do that. I no longer diversify for diversification's sakes. Now, I don't care if I'm 100% into one sector or one industry, as long as it makes sense and I have a solid game plan, but also when it is a sign for me to exit with profits, that's what's more important. Now, that's not for everyone, because to do that, you need a very active, hands-on approach to investing. And that's why the Cheese Public Portfolio Series, I mean, we only have 5 positions in the portfolio right now. I'm very concentrated. For some people, that's way too risky. And for others, it's like, why don't you have 100 positions? Because I used to be on that game plan, and I don't know. I guess with most things in life, you experience it, you adapt, you adjust, you modify, and you tailor it according to your own personal preference, your risk tolerance, and everything else, right? I like Home Depot, but not enough for me to be invested into them. So I think the KPI, what's really important, it's going to show us the contractor demand for home building, because obviously it's not just people doing DIY projects shopping at Home Depot, right? A lot of the independent contractors go there to buy stuff, wood, paint, and everything else. But it also gives us a pulse check for the consumer's renovation and project appetite. So I think during the pandemic, let me just show you what I'm talking about. During the pandemic, once people were locked down into their homes and they got stimulus checks, they were spending a lot of money doing projects to replace their patio, to that toilet that you got to freaking kicked in order for it to flush, finally get that replaced. And Home Depot, at one point, they were $400, right? But I feel like when it comes to home repairs and renovations, it's not something that you do every single week, right? There's seasonality baked into it. And depending on what it is, like that particular appliance or a repair, it could be every 10 to 15 years. But then again, there's people constantly buying homes, or people that had just replaced their stuff. But then there's others that replaced their stuff 10 years ago. So I think it all blends out to seeing a more stabilized number in their gross sales, which seems to be evident, except for 2024, a decrease, 3%. But it's not too crazy. And on the topic of seasonality, Home Depot, as you can see, it's not, I guess, bird's eye view. It's in the right trend. My gosh, 900,000% return. That is beautiful. But there's peaks and valleys, right, in the micro tense. So depending on the season, there's highs and lows. Now, in a fiscal calendar year, the spring season and the summer, it tends to be their best quarters, because that's when people can get outside and start doing stuff. Obviously, winters, the spending at Home Depot is not the greatest. So if this most recent earnings does not hint at bullish guidance, I think Home Depot's selling off. And yes, I'm saying that understanding full well that they're at a one-year low. Because think about it, right? The months leading up to this earnings, it's like January, February, and March. So they should have seen a trend and a forecast developing from the March purchases to see hey, I think in April, May, and June, things are going to be super good for us. If they don't say that, I'm telling you right now, Home Depot, we could easily see 249 maybe even like 230 a share by the end of the week. Now, I don't want to be that kind of guy, but that's just the reality, right? The stock market is not just predicated upon what happened in the past 90 days. It's also based on what's happening in the next 90 days, but also the next 2-3 quarters out, because the markets are forward looking. It's not enough just to execute in the past. It's also, what are you promising in the future? Don't just put a ring on my finger. You also got to take me out to a steakhouse. You also got to get me a manicure. You know what I'm saying? Like, it's the promises that you can also keep. And if you can stay true to your words. And I think this is a perfect time for me to talk about. I just think it's absolutely hilarious to me when people say the stock market is too expensive right now as a generalized statement. And I just feel like, I don't want to come off the wrong way, but I almost think that's ignorance. Because no, my friend, if you look carefully, there are sectors and industries where the entire neighborhood is on clearance. So when we talk about the restaurants, when we talk about medical device makers like Medtronic, software operations, the SaaS stocks, the payment toll booth giants like Visa and MasterCard. I mean, can we just pull up Visa? Ticker symbol V? You take a look at them, and they're almost, well, they're recovering slightly, but they're near their one-year low. Same with MasterCard. But also the BDCs, the business development companies, Main Street Capital, Ares, Blue Owl, the REITs, my goodness, have you taken a look at the real estate stocks? They're all sold off, and that's because inflation is going to stay longer than we anticipated, right? And when the interest rates are high, rates don't do as well. When the interest rates are low, the rates boom. And the crazy thing about the rates, friends and family, historically, up until 2021, they outperformed the stock market, and they were the pound-for-pound best industry in terms of CAGR. Now, ever since 2021, I definitely think the data has flipped, and I do got to look into it, but I don't think it takes a rocket scientist or someone with a PhD from a community college to understand that it's probably tech, right? Anybody adjacent to the AI tech space, like chip makers or Mag 7, it's going to be one of those. It's no longer the REITs, because the past 4 or 5 years have been atrocious for them. But we also have consumer staples like Procter & Gamble, Colgate-Palmolive, Church & Dwight, and of course, the insurance players. That's just to name a handful. There's so many other sectors and industries that are near 1-year, 5-year, 10-year lows. And so when people say, oh, everything's too expensive, I'm like, brother, you're not looking in the right places. Because if you look in the right places, the entire industry is being sold off in that space. And if you look at the only, obviously disregard the bottom 90%, and you only take into account the top 1 or 2 in that space, they're most likely going to be fine and dandy in 5 to 10 years. And if you're a long-term value investing kind of guy like I am, then you know some of those names are opportunities to pick up on the cheap. Now, obviously, if you're looking at the bottom of the barrel, the crappiest ones in a sector, that's what blows my mind. Like, when the entire software landscape is 50, 70, 80% into the red, what blows my mind is, why are some people gravitating towards the unprofitable, cash-burning, disgusting ones that have zero economic moats, when the top 10 in that landscape should be the ones that are flashing lights at you to slow down, buddy. You're speeding in a school zone. Like, that's the ones that I'm personally going to be looking at. Because I gave a pretty detailed post on the Patreon, but I think this is a great time to just give it to you guys for free. When an entire neighborhood goes on sale, right? The mansion, the little house, the little shed on the corner. My whole thing is, why would you ever want to put your money into the disgusting shed that has mold on the walls, where everything needs to be replaced because it's a safety issue? You're not going to be able to get permits approved unless you fix this and that. Like, why look at that? The dumpster fire that's also being sold off alongside with the one that has brand new energy efficient windows, a perfect lawn, great infrastructure, a brand new HVAC system installed, like that one is also 50, 70% off. Why not go for the high quality compounder? Like that's my mindset and mentality. And that's why sometimes from time to time on this channel, I'll get comments from people saying, hey, what do you think about, XYZ? Right? And that's a fill in the blank. And it's usually a stock that an influencer on Twitter, Reddit, YouTube is pumping. And I just shake my head because I'm like, brother, do you understand that this is a piece of crap company? And I'm not even trying to be rude or foul, but I say that predicated upon their P&L. Their gross sales is declining. Their cash flow is non-existent. Their balance sheet is hideous. They're over-leveraged. Their ROIC is negative. And you're telling me what I think? Like, come on, right? All that to say, this is not financial advice, but just like in real life as well, don't consider, contemplate, or even fancy the idea of investing into a crappy business operation. Do not think of these as just ticker symbols, please. Please adopt the mentality of buying into a business operation as a share owner, where you own a piece of the pie and it belongs to you. So having said that, would you be able to sleep well at night knowing that you own a business operation that burns cash, that is eroding, that is having their landscape disrupted by AI or big tech, or the fact that they slashed their dividend last week? Like, why consider those ugly business operations? I'm sorry. I'm saying that because when I was new to the game, I wish someone could have knocked that sense into my head, because I messed around with too many cigar butt companies thinking, anticipating a turnaround when there was no evidence and facts to point to that direction of them being able to come out alive. Right? But when the facts and the numbers and the data point to a direction where it's objectively more likely than them going belly up, that's when you are a true Warren Buffett mindset possessing investor. That's why United Health, for me, was too easy. Likewise, when I invested into AMD and NVDA back in 2023, 2024, when people were bagging on them, when the numbers point in the direction that they will have a rebound, I mean, think about it, right? If you're a business kind of guy, would you ever want to buy and flip a home that's on a very shady block with crime everywhere and all of the other neighbors' houses look like crap? Or would you rather want to buy and flip a home that's in a pretty good neighborhood and it's just, running into some issues? You got to fix her up a little bit and it's boom, back out there producing cash flow. I don't know. I think it really depends on the person, but I feel like I'm preaching to the choir at this point. There's also Toll Brothers. From my understanding, they tend to build more of the upscale homes in designated neighborhoods. I've personally never lived in one, but from my understanding, it's a hit or miss. And there's also Cava Group, which honestly, the restaurant landscape, it's so hard right now to pick who's going to be the winners. And so I've been defaulting and gravitating towards McDonald's because time and time again, it doesn't matter what the trend is, what is hot, what is not. McDonald's always comes out on top. And yes, there are people that are disgruntled with their menu prices and everything else. But the fact of the matter is they're thriving, they're crushing, and they possess a portfolio of real estate in the most expensive areas in the world. You talk about Paris, that McDonald's location, they own it. When we talk about New York City, McDonald's, Manhattan, they own it. And for me, I see McDonald's as a real estate play rather than straight up burgers and fries. Because fundamentally, they're not the ones doing the heavy lifting, right? It's the franchisees doing everything. And then they cut them a royalty check for the marketing expenses and for everything else. So I've been buying into McDonald's. We'll see how that plays out. Cava, obviously they have excellent numbers, but all I'm trying to say is just take a look at their trading multiple predicated upon the trailing 12 months, but also the forward PE based on next year's earnings. So what I mean by that is they're trading for 144 times next year's profits per share. Does that sound good to you? Does that sound like a deal to you? Obviously, their numbers are pretty good, right? A 22% increase in the gross sales year over year. But that's just not for me, Chief. Like, obviously, if that was more a number in the ballpark of like 25 to 35 of a PE, then I'd be like, okay, I think for the numbers that they're executing, this is, I'm going in. But it's not. Their profits per share declined by 50%. And take a look at their free cash flow situation. So Cava, if you're not an American, it's basically the Mediterranean version of Chipotle. Me personally, as an Asian dude, I love Mexican food. Okay? I love it. But a close second would be Mediterranean food. I do like Asian food as well. I don't like authentic Chinese cuisine. I tried so hard, right? I have a lot of buddies that are from Taiwan, from Hong Kong, and everything else. And whenever we eat out, they always take me to authentic Chinese places. Never been a fan of it. It just doesn't fit my palate. Even dim sum, but when you talk to me about American Chinese food, that greasy, deep-fried nonsense, sign me up. I know. My tongue is all messed up. Maybe I just lack the finer things in life. But anyways, I love Greek food. And that's basically what this place is, Cava. Their free cash flow declined also by 50%. So, look, the financials and fundamentals of Cava, I just don't see a world where a 144 PE is justified. All else being equaled, I know that Chipotle's getting a lot of bad press these days, but all else being equal, I'd rather just go into Chipotle. Because any day now, I do believe they're going to initiate a dividend. Because I don't think Chipotle, they themselves, they believe them to be a growth story, a Cinderella that's still crushing. I don't see them that way. I view them the same way that I think about McDonald's leading up to the 80s or the early 90s. You're pretty much mature at this point, and it's just a matter of penetrating international borders. Now, the thing is, once Chipotle gets mainstream in China, Japan, and Korea, I think their numbers are going to explode. Because Mexican food, I don't know what it is, but Asians love Mexican food, and vice versa. You ever go to a Chinese buffet on Sunday? Dude, you'll see Hispanic families left and right after church. That's where they go. They go to a Chinese buffet. So I don't know what it is. Like the palates of the Mexicans and the Asians, it just goes really well together. I'm like, have you ever tried a samgyeopsal street taco? So basically that's like Korean pork belly, but also with some Mexican seasoning, cilantro, some onions on that bad boy. Oh my gosh, it'll take you right out. And then also there's some kimchi that's fried on there as well. So I personally think Chipotle has more room to grow, but they're not necessarily like this startup that's nimble and lean that they think they are. They're really not. But they do possess the same DNA and characteristic traits as McDonald's. So I do like Chipotle. I just would want to see this number, the forward PE ratio, closer to a 20 before jumping in. Because, I don't know. Even at a 27, I don't think it's too outrageous, but I like to buy companies with a margin of safety baked in. But also, let's take a look at what else is happening. There is Urban Outfitters. Kind of a weird thing is, here, let me take a sip of my green tea. When I was in college in 2010, I know, the face, I look really young, but I'm kind of old, okay? I used to exclusively shop at Urban Outfitters for all of my outfits and everything, right? But then once 2012 rolled around, I think I made the transition to some other brand. I think it was Uniqlo, which is the Japanese version of like Gap, the best way that I could describe it. And my whole thing is when it comes to apparel retailers, gosh, it's so hard to have the consistency of staying on top forever. Because even Nike, the king, right? If we just pull up and take a look at Nike, here's the thing. They used to be the kings, right? When it comes to athleisure wear, sneakers, the Jordans, and everything else. Dude, nobody wants to wear Nike anymore. Oh my gosh. If you bought into them at about $175 a share in 2021, as a buy and hold investor, to be just holding on and seeing it drop to $41, I feel for you. That's why I disagree with the mentality of doing nothing. I think buy and hold, but also have a coherent exit strategy. Like if they change their investing thesis, if their operations get throttled, if the game plan for the company going forward changes drastically, if they cut their dividend, or in this case, if the price drops by too much and it's going to go to $30 by next fiscal year with the cost basis of $175, it's like at that point, brother, you know what I'm saying? And that's why I personally don't do buy and hold forever. I definitely do buy and hold long term, but I think Nike is a really good example, right? Like you buy into them at $175 in 2021 and you just continue to see them drop into the red. It's like, because after the initial drop to 110 or even that rebound back to 127, even to cut your losses there from 175 to 127, it's not as bad as cutting the losses at 175 down to $20 a share. And that's why I personally don't do buy and hold forever. But that changes when we talk about the sectors that I believe are buy and hold forever, where you don't have to monitor your portfolio every single week or every single quarter. Believe it or not, I uploaded a video talking about just that. But when it comes to apparel retailers, they are not buy and hold forever. So everything that I just said is specifically for Nike, for Lululemon, for Under Armour, for Gap, Urban Outfitters. And the reason being is that fashion, trends, and what the kids deem as cool, it comes and goes, right? What's cool today, 5 years from now, as the kids say it, will be cringe. And that's why personally, I don't like investing in apparel. Because we really don't know. It could have all the rage right now, like Hoka Ona Onas did at one point. And now, I think they're represented by Decker brands. They're struggling. I think they've been overtaken by On, the Swiss brand of shoes that look like Nike Shocks. And it's just a never-ending cutthroat competition where you might be good today and you're irrelevant tomorrow. And we can go on and on with so many examples like VF Corporation, the parent company of Supreme. In the early 2010s, I want to say like 2012, 2013, 2014, I remember the sneakerhead culture and Supreme, it was all the rage. Now, Supreme, nobody wants to wear it, right? So when you buy into stuff where it's that, or it has that type of boom and bust nature in the DNA, you have to be really hands-on. So, I mean, you can call me a bad guy, but I'll go on record. I do not think apparel retail stocks are buy and hold forever. They're really not. You have to know when to sell. You have to, like if you know full well that Under Armour is going to make a comeback because they have this social media trend happening with the hottest singers and influencers, and your kids are always begging you, Dad, I want to buy new Under Armour shoes. And Under Armour is, I think they have two different stocks, but let's take a look at just this one, okay? Ticker symbol UA, and they're $4.90. And you see the hype happening around you, and their financials and fundamentals are pointing in the direction that they're about to explode in valuation. You buy into them, and you see them explode to, I don't know, say you buy at the $4.90 and they jump up to $10. you better be ready to jump ship with 100% gains and be a happy camper. Don't buy into them at $4.90, buy and hold, do nothing. Okay, I think the better example is buy into them at $8.70 in 2020, do nothing and see them go to $20, and then you see them drop down to $8 and whatever your cost basis was. You fast forward a few years and now it's $4.99. So apparel retailer, I don't like because of the boom and bust nature, but also the idea of they do not have a competitive advantage against the competition. Just like when Lululemon took Costco to court last year, it made all the headlines, at least it did on the online business websites that I like to frequent. Dude, the judges were like, get lost. What are you even... No. Costco is definitely allowed to make knockoff Kirkland branded leggings of whatever you're making. Why? Because it doesn't say Lululemon on it. And that's when I learned quickly, or I guess it reinforced the idea that apparel retailers, they do not have an economic mode. No, not even the brand, not even the logo, no. Like the kids might want to be wearing it while they go to school right there and then. But then in 2 to 3 years, it's nothing. Just like back when I was in high school in 2006, everybody and their boyfriend and girlfriend, everybody wanted to wear Sperry's, which are boat shoes. You fast forward to 2026, nobody wears Sperry's. I personally do, right? Nobody wears Sperry's. How do I know this? Because they're owned by Wolverine Worldwide, and they even say that they're struggling. So it doesn't matter, friends and family. Apparel retailers, no matter how much conviction you have in them, they don't have a durable future where it's consistently they're going to be crushing. Nike, the king, even they have fallen. There's way too many brands sprouting up left and right. Okay, I'm sorry. I think some people get it. Some people don't. All I'm trying to say is I personally will never invest into apparel retail brands. Doesn't mean that anybody has to listen to what I'm saying. Oh my gosh, friends and family, can we talk about Red Robin? Personally, I love Red Robin. When my wife and I, our early years of marriage, this is one of the places that we used to frequent. Reason being is that Red Robin, their burgers taste phenomenal, but because of the bottomless fries. Yes, when we were both struggling with our budget and we weren't making much money, we had to take stuff like that into consideration of like, okay, what's the best bang for our buck? And for Red Robin, to get an unlimited basket of fries, sign me up. The sad thing is, the traditional modality of sitting down and eating at a restaurant, which is the format that Red Robin operates in, it's a dying model, right? Especially for the burger and fries landscape. Because people prefer Five Guys or Shake Shack or McDonald's where there's no server, where you just get your food yourself and then you're on your way. That's what they prefer. Then again, for families, it's the different landscape because I think families prefer sitting down and having a server bring your drinks or top you off on your milkshake because you're a fat lard or whatever it is that you need, right? And that's why we're seeing evidence of success in Chili's, in Texas Roadhouse, in Olive Garden, in Maggiano's, for the families. But for Red Robin, I just take a look at their financials, okay? So in 2016, they posted $1.3 billion. That's a lot. In 2025, they executed $1.2 billion. So you tell me, in the past 10 years, Red Robin, they've gone nowhere. They're stagnant. They're not growing. They're shrinking. All that to say, Red Robin, it's truly a sad thing to see. Because I remember during the pandemic, that was the beginning of the end for them. Because once the consumers were not allowed to go out to eat and sit down at a restaurant to eat, Red Robin, their business model was just completely disrupted. Because then the consumers were forced to try out Five Guys, get something to go, or McDonald's drive-thru, and that's where they just stuck with ever since. They just never went back to Red Robin. Now, obviously, that's hyperbole because they're still generating $1.2 billion of revenue. But the fact that over 10 years, the fact that you have not grown your top line, I mean, that's a huge concern, isn't it? Meaning they lost customers. Or they just kept the same ones and charged them more per menu item. It really depends. But let's jump on over to Wednesday. I feel like we spent way too much time on Tuesday. So obviously on Wednesday, we have NVIDIA, and that's going to be the biggest name, okay? And leading up to that meeting in, China, beginning of the week, they were at, what would you say that is? Roughly $2.15 a share. And then leading up to, or I guess during the meeting, they were $2.36 a share. I'm not going to lie to you, FOMO got to me. I was like, should I do it? Should I not? And whenever I have a big decision to make like that, I like to clear my mind, right? So I went on a 6-mile run, and I thought about it the entire time I was huffing and puffing, because I'm a fat piece of crap that's out of shape. And once I got back inside, I was like, I'm not going to do it, because it's not a data-oriented decision that I'm doing here. It's emotions guiding my principles. I'm trying to buy in because the markets are getting rosy and optimistic about a deal being done for NVIDIA. Because think about it, the upside, if I bought in at 236, what? Maybe they'll pump to 240, 250. But the downside implications were, I understood if things don't work out, I can absolutely see them dropping back down to 190 a share by the end of next week. And that's exactly what's happening. After the markets realized that NVIDIA, nothing was going to happen with China, they went from 236 down to 225. And I think they're continuing their selling trend because in the after hours, or I guess pre-market hours, they're down another 0.4%. I'm not trying to be negative, but I do think NVIDIA might flirt with 199. And the reason being is, you can call me crazy, I think they're going to have a lights out earnings. How do I know this? Because AMD, Marvell, Intel, they've all been crushing. So what makes you think NVIDIA is going to be any different? NVIDIA is also going to crush, and their guidance is going to be bullish. However, the stock is going to sell off because I think all of it is going to be priced in. I know. But the crazy thing is, I don't think they're going to stay near 190 or 199 for too long. I think after that sell-off, they are going to recover, and we'll probably see them closer to like 205, 210 when it's all said and done in a week and a half. NVIDIA, I really do like, but just like, wow. I remember during the pandemic, I don't know if I told you guys this or not, I invested into NVIDIA not because of the AI thesis, but because the computer that I use, it utilizes an NVIDIA GPU to render my videos at I think it's like a 60 or 70% faster rate prior to not having a dedicated graphics card. And once I saw that, I was like, okay, I'm investing into them. And I put a crap ton of money into them back in 2021. And I fumbled. I sold out of them at the beginning of 2024 after I saw a 300, or was it like a 400% ROI? I was wrong. I did not think that they were going to go any higher. So this is one of the instances where I should have just done nothing. Buy and hold. Do nothing. So I guess there's levels to this game. Apparel retail, definitely not buy and hold. But depending on your cost basis, when it comes to the AI bubble, it's just crazy. It just keeps going higher and higher. AMD, the utilities, the HVAC, the construction, they just keep going higher and higher. Now, obviously, when the bubble bursts, when something pulls the rug and everyone has their pants down by their ankles and everyone's ding-dong is shriveled up because they do cold showers, because cold water makes things get small. The ones that are caught holding the bag, like if you buy into Micron, SanDisk, Seagate at all-time highs and you're caught holding the bag and they have a pullback of 20, 40%, it's not going to be a good day. So I definitely do think there needs to also be an exit plan for the AI bubble stocks, but for the time being, I don't think things are going to slow down. What is the sign that things will slow down? I think the commentary and the narrative and the guidance given by the hyperscalers, like, hey, I think we're happy with what we achieved. I don't think we're going to be spending $400 billion on data centers this upcoming year. I think that will be the first sign. Or maybe it's going to be government regulatory restrictions placed on power, placed on water, placed on whatever it is, and it throttles the data centers, their full capacities from being built out, or permit restrictions. I don't know. I'm just speaking out of my butt. But there will be a beginning to the end of the bubble bursting. Or this is the new reality. Maybe this is the age of the internet all over again. The data centers, like every, I don't know, public land that has just trees and nothing else around it, maybe a small little lake, maybe they'll all be data centers in the next 20, 40 years. We don't know. Maybe there is no exit plan. Also on Wednesday, we have analog devices. I do want to talk about them because I made a very... Well, hold on. They're lesser known, okay? But they're benefiting from all the data centers sprouting up over the country. And that's because they're not exactly making chips for the language learning models, but they make chips that help the entire thing run. They make power management chips that help the AI server racks extract the precise amount of power to do what they need to do. That's the best way that I can describe it. And the only reason why I know about them is their only real competitor in that space is Texas Instruments. And I made a dedicated video talking about Texas Instruments, how I thought they were screamingly undervalued at 130, 140. Right about this point right here. And for some stupid reason, people still associate them for only their calculators, which is kind of funny because the calculators only make up like 3-4% of their revenue. Their chips are also utilized in handheld devices, cars, manufacturing, robotics, everything. So they're lesser known, but I do think the ship has sailed. Like if you're thinking about jumping in while they're at all-time highs, I don't know what to say to you. But then again, maybe in 5 years, I mean, it's 400 right now. Maybe in 5 years, they'll be at 800. So what were you saying there, buddy? You said they were overvalued, but now they're 800. So that could also be the case. But me personally, right? I'm not trying to jam my ideology and philosophy down the throats of folks here for the kind people that are tuning in. Me personally, like if I were to invest into analog, I would need a pullback. I would want to invest in when they're like, I don't know, $2.99, maybe like $2.50 a share, right? When there's a market-wide sell-off, like that's when I would want to jump in. But to jump in when they're at all-time highs, that goes against the whole premise of value investing, which is to buy into high-quality compounders when the market has priced them incorrectly, when they're on a discount, when the PE ratio should be at a 35 like it is for analog right now, but it's 20. So, yeah. TJ Maxx, Lowe's, the exact same thing that I said about Home Depot applies to Lowe's, except that it's kind of like a Walmart and a Target situation. The shopper demographic is a little different in that Home Depot has a bigger pull and a market share of professional workers, whereas Lowe's has a bigger market share of the folks that are doing DIY projects. So that's the only real difference. And my stomach is grumbling. I don't know if that picked up on the mic. All this talking is making me freaking hungry. And also on Wednesday, we have Intuit. They're in the game. It's a software giant that's in the game of Credit Karma, tax software, and some other stuff that helps with like your payroll and whatnot. And to keep you in the loop, Q1, that's tax season for us Americans. So I think Intuit, their earnings should be healthy. Like I think it should be good. But that's not what the markets are going to care about. I don't think the markets will care at all about, oh, here's our revenue, how much we... No. I think the markets, they're going to want to pay attention and hear what are their efforts to monetize their AI features? Because Intuit's been talking about, hey, we're going to implement this and this and this. But the thing is, the markets are thinking about like, okay, well, how are you going to make more money off of that? Just like with Adobe. Like Adobe is also, they're posting really good numbers, right? But they continue to go into the red because they had just started to monetize their AI features. By the way, I no longer use Adobe products. I started using DaVinci Resolve. And I think that's what opened Pandora's box for me to realize Adobe, they might have partnerships with the biggest enterprises in the S&P 500, but when it comes to independent creators like me, once I learned that DaVinci Resolve can do the exact same thing that Adobe Premiere Pro can do, which is a video editing software, but then some, and I don't have to pay a subscription fee, that's all it took for me to jump ship. But just like with Adobe, right? Intuit, excellent numbers, but the whole idea is, will vibe coding and Anthropic's Claude, will people just vibe code their own software to do their taxes for them? And I think that's idiotic, right? When I think about the SaaS Tier 4 landscape, if you don't know what I'm talking about, please go watch that video, because I did a crap ton of deep dive that I was originally only going to post on the Patreon. And then I realized, dude, I think I should post this on the YouTube for free. Out of the Tier 4 landscape, off the top of my head, there's only 2 or 3 that I would personally want to invest in, and Intuit is one of them. Adobe is not. One thing that you want to keep in mind, though, with Intuit, last earnings, the only blemish that they had here, let me pull up their numbers because I want to be a visually inclined person. That way, for the folks that are just staring at the screen that's not moving, I don't slap you across the face. I'm sorry. Yeah, if you break it down on a quarterly basis, their last earnings was lights out. 17.3% growth in their top line, which is an improvement because in 3 years ago, Q2, or I guess 2 years ago, Q2 2024, they posted 11% growth in their top line. So in the age of vibe coding and AI, Intuit's growing and they're doing better. Their EPS grew by 48%. So last quarter was lights out. The only blemish that they had, the only line of business that didn't do too well was MailChimp. MailChimp did poorly, which is the email marketing arm of Intuit. Basically, it helps keep track of like the 200 people that are signed up for your, I don't know, your chess club email, and you send an email every Wednesday talking about, hey, chess tip of the day. That's MailChimp. So we'll see if they improved anything to change the momentum for MailChimp. I personally think that Intuit's going to have a really good earnings. Again, that's not what's going to move their stock price. It's going to be their commentary about how their AI-enabled features are driving meaningful change in how much money they're processing. If they're not bullish with that commentary, I don't want to be that guy, but I think Intuit's touching 350 by the end of the week, which I hope they do because I've been eyeballing them. I don't think people are going to vibe code their own tax software because think about it. There's legal ramifications if anything is wrong. And Intuit already has your past 20 years of tax data, and they know exactly how you like to do things. And it's the standard. So why mess around? Why play with fire? Why break or fix what's not broken? If you already have a software that works for you, why jump ship to save $1, to save 50 cents? Other stuff? Okay, jump ship for that software. But when it comes to, like, if you're a small business owner, why take that risk? So I'm trying to think of the mentality of who they cater to, which are like middle or small size business operators that own like a laundromat or a car wash chain or a restaurant. They're not going to want to jump ship. I'm telling you right now. I mean, some of them will, but it's not like me jumping ship from Adobe to DaVinci Resolve that does the exact same thing, but is more user friendly. So I don't know, guys. We'll see. We'll see. But enough about Intuit. Let's go ahead and talk about Target. Target is reporting their earnings, and let's take a look at their price action. Oh my gosh, for the past 6 months, in the green 35%, which is pretty darn good. And unless you're not in the know, Target right now, they're in the middle of a turnaround Cinderella story. They changed leadership. They're changing their marketing tactics. They're trying to change everything in order to win their consumers. Because this is the example of a company that flip-flopped by playing the political game. They catered towards the right for a while, and then they catered towards the left, and now they shot themselves in the foot because both sides of the political aisle hate Target. But one thing that I do know is if you're a middle-class white woman or an Asian woman, you'll still shop at Target. Because there is a consumer base that refuses to walk into the doors of a Walmart. Not because of what Walmart stands for, but because of the customer base that shows up at a Walmart. Funny story is, a handful of times I have witnessed physical altercations at a Walmart where people fist fight each other. So it makes sense. Then again, I feel like Walmart, they've been rebranding themselves to be cool with the younger generation. So I feel like that stigma is also going away. But Target, their last earnings, I tuned in because it was a company that I sold at a profit because of that earnings. It was atrocious. But the guidance that they gave was like, hey, I think the worst is behind us now. And I think their tactics are working because the customers are coming back. I mean, if you take a look at them, their numbers have been stagnant for the past 3.5 years. $109 billion in 2023. It's $104 billion in 2026. A lot of that can be attributed towards them closing their unprofitable locations, mainly in San Francisco, Portland, and areas where there was a lot of shoplifters where people would go in and just steal a bunch of stuff and run out. They closed those locations. And so their top line decreased, but their EPS increased, right? In 2023, it was $5.98, and now it's $8.13 in the trailing 12 months. Who would have thought, right? Once you stop all of the theft and shoplifting, your margins improve. But having said that, Target is an interesting one. I've made profits off of them, I feel like 5 times in the past 6-7 years. It's one of those that I like to buy on the dip and sell on the rally. Reason being is, Target is not Walmart. Target is not Costco, and they're not trying to be. Target is the prime example of who Macy's used to be in the 80s and the 70s. A consumer discretionary place where you go to buy furniture, where you buy new blankets, where you buy clothes. That's who they've been. But I do think that Target, based on the last earnings, from my understanding, they're trying to copy Walmart's playbook. Instead of just optional spending items like beauty products, accessories, and shoes, they're trying to gravitate towards more consumer staples. Their own private label food brands, laundry detergent, and everything else. And to be honest with you, I actually support that. I think that's smart. So my whole thing is, for selfish reasons, I do hope that Target sells off so that I can jump back in. Because I previously bought into them right here at this dip. My cost basis, I kid you not, was $85. And I sold out of them at, I think it was $115 or $116 a share. I was a happy camper, but I really do hope they have a pullback so that I can jump back in and I can sell again once they have their rebound. Reason being is I really like their dividend profile. A 3.8% dividend yield, 56% of their profits are used for the dividends. 55 years of growing the dividend. There were the ups and the downs, the recessions, the invasion of Iraq, and everything else. They grew their dividend. So I would like to buy them for the dividend, but also for the short rally. I don't know about a buy and hold unless they show signs and symptoms of being a Walmart 2.0, which I would say is a really good game plan. Because everyone and their ex-wife thought that Amazon was going to make Walmart obsolete. And now we're finding out that it's the exact opposite. There are some people that prefer Walmart to Amazon because certain things in life, you need to go into the store to Put it into your fat, pudgy fingers and your hands to see whether or not you like it before purchasing it. And I think Walmart, they've been going gung-ho with their own branded stuff. Shoes, clothes, food, products, that great value brand. Not gonna lie to you, they're making a comeback. How do I know this? On social media, I've been seeing posts pop up of like 5 things you need to buy at Walmart made by influencers that have millions of followers. And I'm like, that's something you've never would have seen 10 years ago, let alone 5 years ago. So they're properly utilizing social media and channeling to a younger demographic that now thinks Walmart is cool, which is interesting because that's where I shopped at as a poor kid growing up in poverty. That's where we went. We went to Walmart because we couldn't afford the other places. Matter of fact, that's where I got my once a year new school clothes at a Walmart. So yeah, it's kind of interesting to see the glow up, right? I'll never forgive. Well, I did forgive, but I'll never forget getting made fun of when I was a young kid for wearing Walmart shoes. I mean, for crying out loud, it's because my mom could not afford Nikes. Because in the 90s, I'll tell you, Nike was all the rage. It was a status symbol. They had that at one point. But to show up to school wearing Walmart shoes, here's the thing. Kids can be ruthless on the recess and on the playground. Yeah. But anyways, there's also Hasbro, which I'm finally starting to understand. At one point, I was like, why would anyone want to invest into the parent company of all of the various board games and physical toys that are sold on the shelves at a Walmart or Target? And then I realized Hasbro is much more than just that. Their dividend profile is okay. It's not the greatest in the world because they're not growing it or anything. Reason being is that they own the intellectual property to Magic the Gathering and Dungeons and Dragons. So for the longest time, they would only sell those cards, right? Or I guess the pamphlet to play Dungeons and Dragons. But now they have made the transition to digitalizing their offerings and their products. So now there's video games, now there's movies, now there's... Here's the thing. I think Hasbro's growth story is kind of interesting. They've made the successful pivot into being relevant in 2026, because you would think a company that only... Here, take a look at it. Past 1 year, 46% into the grade. Obviously, that's nothing in comparison to SanDisk and Micron, but those are outlier examples. To see a 46% ROI in 365 days, I don't care who you are, that's really good. Because you put your money into your bank account, your high yield savings account, you're lucky to see, what, a 2.5% interest rate? So when you bring yourself back down to earth, 46%, that's really good. So Hasbro, I put them on my watch list. That's a company that I do want to enter, just not at their fat valuation. Every single day of the week, I would pick Hasbro over Mattel. Mattel is also a toy manufacturer, but when you think about their customer base, it's mostly children under the age of 9, because it's Hot Wheels, it's Barbie, and some other stuff that caters towards the pre-K, pre-kindergarten crowd. Whereas with Hasbro, it attracts a customer base that's young and old. Because when I think about the average Magic the Gathering or Dungeons and Dragons kind of guy, yeah, I said guy, I think about him as a 45-year-old that has facial hair. And they have a lot more disposable income to spend, to buy, to redeem for more tokens on the game that they're playing. So, I don't know, that's how my brain works. So that's why I'm more bullish on Hasbro. There's VF Corporation, that's the parent company of Supreme, but also North Face. Again, North Face used to be the hottest outdoor brand in the 2000s. Now they're nothing. I won't go as far as say nothing, but they don't have the same reputation that they did in the past. I think now folks are realizing that there's levels to the outdoor gear game. There's, what's that Canadian brand? Arc'teryx. There's also Patagonia. There's also the one out of Japan, Montbell, which to me, I think it's overhyped. It's about the same quality as Columbia Sportswear. So it's not the greatest, but it's just about in line. So when people hype up Montbell, I'm like, I don't think you guys understand. I live in Japan. I've tried on their stuff, used their stuff. It's not top tier. I would say it's like middle of the road. But again, North Face, perfect example of things coming and going. And then there's Elf Beauty. I'm not going to lie to you. I spent maybe like 7.5. No, that's a lie. I spent more than that. Maybe like 11 to 12 hours spread out across 3 days just researching and analyzing Elf because they're at a 1-year low. Okay? I didn't make a dedicated deep dive video for them because it's not really a company that should be on the radar for anyone. They're in the game of selling off-brand generic makeup and skincare products for young women. I say young because this is not the brand that you buy if you're over the age of 25. So they'll make stuff like foundation, lipstick, mascara for the youngins, you know, the ones that are like 12, 13, 14. Obviously, past 1 year, negative 26%. Past 3 months, negative 30%. It's not looking too hot for them. And the reason being is the financials and fundamentals are solid. Really. But I think what's hurting them is after looking into it, there's a boycott happening right now. Their customer base is disgruntled with them. They did an advertising marketing campaign with an individual that I think he's like a stand-up comedian who made jokes about beating your wife or something like that. And consequently, the customer base, rightfully so, they're super outraged and now nobody wants to buy their stuff anymore. But the bigger reason is they resonated with the youngins because they would produce and sell products of like name brand mascara from Sephora or Estee Lauder or whatever these high upscale brands. Their mascara would be like, what, $80? And Elf would try to sell a mascara for $1 that replicates pretty much what the high luxury product aims to do. Instead of selling that mascara for $1, now Elf is trying to sell it for like $15 or $18 or $20. And their customer base is like, listen, you're no longer budget friendly. Now you're just as expensive as the competition. So now I just want to buy, I would rather buy the upscale stuff. Because if I'm going to be paying $20, I'd rather pay $20 to get the real name brand stuff instead of getting the off-brand stuff. So this is an example of where off-brand and generic brand is going against them because of their pricing strategy. So ultimately, my conclusion, I don't want to go near them. I think there's just too much uncertainty surrounding them, but I can absolutely see them crushing and ballooning back up to $70 a share. I can also see them pooping their pants and dropping down to $29. My entry point when I did my research, I think it was like $29.89, but I'm not going to go through with it. If I'm wrong, please feel free to correct me, but that was my understanding of Elf. And that's why doing an analysis is so freaking important before contemplating jumping into a position. Now that I understand the soft side of the business and their customer base not liking them, yeah. For instance, their Instagram posts used to get like 50, 60,000 likes per upload, and now they're lucky to see like 1,000 likes. That's a pretty steep fall off, if you were to ask me. Thursday, we've got Walmart, which I really like as a company, but I cannot justify Walmart at a PE ratio of a 48. I really can't. Likewise with Costco having a similar PE, I can't justify that as a retail brand. I just can't do it. I do like them though. And then we also have, there's Workday, Copart, Like last week, remember I went on a tangent and a rant about Copart, and nobody offered or stepped in to talk about why they're bullish on Copart. I remain on my stance of being bearish on them. And then there's Zoom Communications, which I remember during the pandemic, this was the hottest stock ever. At one point, friends and family, they were $5.59 a share in 2020. But it makes sense, right? It's a video conferencing platform. And when everything was shut down, you couldn't go to work, you couldn't go to school, you couldn't go to XYZ. Everybody had to do everything through video conferencing. So I get why they ballooned up in valuation, and now they're $100 a share, and I still think that's too expensive. That's not fair, Amos. Why do you say that's that? No, their numbers are good. Here's the thing. I'm not thinking about them today. I'm thinking about them 3, 4, 5 years down the road. They have zero economic moat. What it is that they do, there's nothing that separates them from the competition. Google rolled out their own version of Zoom called Google Meet. Microsoft has Microsoft Teams. Cisco has WebEx. So my whole thing is I get really skeptical and cynical, because I tend to be a pretty optimistic guy, of investing in tech stocks that have no competitive advantage or a durable moat against the competition. So if somebody already has a Microsoft license, like an enterprise level, or Google, why pay another for Zoom when you can just keep it all in-house and just do it through Microsoft? They'll probably give you a discount, right? So with Zoom, it's not for me. I don't know who it's for. If you're interested in them, you got to let me know. Yeah. Speaking of which, I got my MBA, I want to say now 6 years ago. So I was wrapping up my MBA during the onset of the pandemic. So I got to experience what it was like to go to grad school, in person, the networking, phenomenal. But then I feel like my experience also turned south because everything went online. So every class, every team project, everything in the second leg, the MBA experience, it was conducted on Zoom in my last semester, and it sucked, right? Because I feel like I missed out on that. It doesn't matter. I think everything worked out the way it should have. Now, even though it's been 6 years since I've last been in school, I want to talk about this because I think it's kind of crazy. The cost of attendance for some schools here in the U.S., for a lack of better words, it's just bizarre and nearly a scam. When you talk about the University of Southern California, the cost of attendance, when you bake in tuition and housing, but not baking in the NIL fees, the digital fees, the printer fees, and all the other stupid fees, USC charges $95,000 a year. For some of you watching this video, you don't even make $95,000 a year, and yet they charge $95,000 a year. Duke, $94,000. Boston College, $93,000. Now here's the thing. I went to a pretty good school on a full ride scholarship. Okay, so for me, I feel blessed and thankful for that. And that's because if you have a pretty good academic pedigree, but a good resume and everything else, schools want you. Whatever. But I think about the poor family where they put their hopes and dreams of their child, living a better life, and they get into freaking USC. And it's like, well, it's $95,000 a year if you want to come here. And for some stupid reason, they don't qualify for financial aid because their family makes a little too much income, but they're also struggling at the same time because they live in California. I think about them, right? And I'm like, dude, at $95,000, and you times that by 4, and you bake in all the other miscellaneous fees, that's $400,000 to get a freaking degree. Me personally, I don't think I could do that. I mean, I'm thankful for the reputation and the name of the schools that I went to because they're all good. But if not for the scholarships, like, man. But real talk, I don't want to I don't want to be too harsh because I think college is it's still a good deal, especially if you come from a family or a background where you're the first to go. Like if you come from a family where you're already pretty wealthy, you already had money, I think college, it's optional. But if you're trying to make it, you're from an immigrant family, and like college is almost mandatory because it opens so many freaking doors, right? College is also, it presents you networking opportunities with other like-minded individuals, and it's a prerequisite for law school, med school, or even to become an engineer. So I think college still has a place. I just think the real scam is in having 18-year-olds sign up for student loans when they don't fully understand the implications of having debt they cannot default on. What's really sad is a prime example is my wife. She has a lot of student loans. And once I married her, those student loans became my student loans. So for me, I take it personal. And at the time, she, being a young 17-year-old senior in high school, she didn't understand about the student loan game and everything else. It's just everybody, including counselors and teachers and everyone around there, they were just saying, hey, you're smart. You need to go to this college. Like, this is a really good school. You got in. You got to go no matter what it takes. Take on every loan you can. And I hate that that's the primary default conversation, instead of saying like, hey, you got into a good school, which shows me that you are smart. You have what it takes to survive and succeed in a institution of that caliber. So what I'm saying is go to community college, knock out 2 years, get your associate's degree, graduate with a 4.0, pivot, transfer on over to the exact same tier 1 school, but with scholarships this time, because you're coming in as a transfer student that shows that you can get a 4.0 in college instead of going on over there with loans. And if you don't get a scholarship, at least you only have to pay for 2 years instead of 4 years. Like, that's what I would say. Well, obviously, I'm not a counselor. So I understand that the student loan industry is a business and they want to continue harvesting young 18-year-olds signing on for life to pay back those loans. We're still paying back the loans. So I'll stop. You know what? I'll stop. And then also we have, there are some names here, but nothing too crazy. Let's jump on over to Friday. There's Booz Allen Hamilton. I also just looked into them and Leidos, another defense contracting consulting firm. And for me, I'm going to continue to be on the sidelines. I just feel like with the current administration, because in the past, anybody that did business with the government, it was almost a guaranteed backlog, revenue, consistency, reliability. With the current administration, none of that is a guarantee. So with Booz Allen, I really like them, but not enough to jump in with so much uncertainty surrounding contracts. So that's where my head is at. And I think the rest of the names on Friday I don't know them. And before I get out of here, I have no one else to talk about it with, so you're going to be the unlucky one. So on my social media feed, these days I've been scrolling on my phone a lot more than usual because taking care of a baby, sometimes it's really boring, right? Like when you're feeding them a bottle, you can only look into their eyes for so long, and then you're like, okay, let's do something else while we do this at the same time. So sometimes I be scrolling, okay? A video popped up that had 25 million views. I think it was like maybe closer to 28 million. And it had over 200,000 comments, okay? And it's a video of a young lady filming her experience of graduating from college. She's like vlogging, and it's like, 15, 20 seconds long. So whatever. And her last name, it starts with the letter A, meaning she's one of the first people to walk across the stage and to get her diploma when her name is called. And what's kind of crazy is as soon as she got her diploma, like you see the phone popping up, and she walks straight into the stands, vlogging the whole thing where her family is, and they walk out together. And she talks about how I got what's mine. I don't care about other people. They're all strangers to me. So why should I have to sit through this entire ceremony? Is anybody else like me? And I kid you not. Thousands of comments saying, yes, girl, slay. Or, yeah, I would do the exact same thing. Everyone agreeing with her mentality and her actions and behavior. And I kept thinking like, man, I don't know if it's because I'm getting old, but between you and me, that mentality right now of the youth, and I say that because they're all like, what, 20, 21, 22? It makes me so concerned about our future generation because they think it's so funny to walk out of a graduation just because you got your diploma and now there's 200 or I don't know, 500 students after you that still need to go up and you're laughing because you don't have to sit through that. For me, I just think how that's so self-centered, how they just lack consideration for others, they lack patience, and they don't understand the concept of manners, of giving respect to people who went through the same experience as you did. But to slap them in the face and say, nah, y'all are a bunch of strangers, I don't care about you, I got my diploma. I could never see myself doing that. Because my whole thing is, when you think about it, not everyone who walks across the stage, they're not going to have loved ones in the stands to cheer for them. Right? Just because you have the privilege to have your family come out there, yell and clap their hands when you got your diploma and you walk out together, I take that personally. Because there are some people who work their balls off, going to night school, working part-time, feeding a family at home while trying to get your degree, and it took you 15 years, what took this girl 4 years, and they have no one there to cheer for them. And that's why I always clap and I cheer for every single kid or individual that walks across the stage or when it's time to give praise. Because I don't just think about it from a selfish lens of me and my group in my community. I think about it from the person that has nobody there for them. To walk out on them, I don't know. So that's why I'm not even trying to push an agenda here or anything. But what happened to the whole idea of loving your neighbor and just being kind and being thoughtful, right? What good is it to have a degree, but to have a rotten soul? And to see thousands of young people agree with her mentality and actions, it made me kind of sad. But maybe I'm the one that's in the wrong here. Maybe I'm stupid. I don't know. Anyways, I love you guys. It was cool hanging out once again. We'll do it all over again next week. Stay safe. Good luck in the stock market. And I will talk to you next time. See ya!